In this week's video, we'll review the latest charts to help us answer the question, are stocks setting up for a 1987 or 2000-like plunge? The upper portion of the chart on the left side of your screen is a monthly chart of the S&P 500. The indicator on the bottom is known as ADX. It can help us with the direction and strength of a trend. As we walk forward, keep in mind, we use ADX as a context tool rather than a timing tool. This chart is dated September 30th, 1982. You can see black ADX has been falling, and at this point, black ADX is below both green and red. This type of ADX setup is typically indicative of a sleepy and/or trendless market. Similar situation, June 1992, ADX black is below both green and red. September 2004, similar setup. Black ADX has fallen a long way, and now it sits below both green and red. S&P 500 monthly dated November 30th, 2010. ADX black once again below both green and red. Very similar look. End of July 2016, ADX black has been falling, and here it is below both green and red. Here are all of the cases that we just covered on one page, and in order to learn something about 2020, it would be helpful to ask and answer the following question. How did stocks perform in each case walking forward? In each one of the cases, we'll take this point here with this setup here, and then walk forward from this point in the S&P 500. In the 1982 case, really good things happened for a long period of time. The S&P 500 entered a secular trend, a trend that didn't end until the year 2000. The S&P 500, after we could see this, measure it, and put it in a model, tacked on an additional 1,168%. Similar situation, June 1992, from this point here with this look here in ADX, we'll walk forward in the S&P 500, and once again, good things happen for a long period of time with an additional gain of 274%. Very similar setup, end of September 2004, and very similar and bullish results in the S&P 500 walking forward. From this look here, the S&P 500 tacked on an additional 40%. November 2010, from the sleepy ADX look, once again, good things happen for a long period of time. The S&P 500 is tacked on an additional 186%. July 2016, sleepy look. After the sleepy look, the S&P 500 tacked on an additional 55%. These are our bullish setups. Now let's examine a totally different look on ADX. December 1936, ADX black now is above both green and red, and instead of falling for a long period of time, it's been rising for a long period of time. If you know ADX, this is an extended or vulnerable look. Remember, this is a context tool, not necessarily a timing tool. Might be helpful to contrast this extended and vulnerable look in 1936 with the look that we've already reviewed at the end of November 2010. You can really make an argument that this look here is somewhat of the polar opposite of this look here. We had similar and extended looks in May of 1946, August of 1987, March of 2000, and May of calendar year 2015. These are our extended looks, and before we review the chart of 2020, it might be helpful to know what happened walking forward in each of these cases. Same basic approach. This chart on the right side of the screen walks forward from this point, in this case December 1936. This is walking forward when we can see this, measure it, and put it in a model. As you might have surmised, rather than good things happening for a long period of time, with the polar opposite look, bad things, really bad things happen for a long period of time. The S&P 500 didn't make a bottom after this December 1936 look until calendar year 1942. The loss, after we could see this, measure it, and put it in a model, was 56.52%, and that's in the S&P 500 index. Similar extended and vulnerable look, ADX, May 1946. If we walk forward, once again, it was a painful experience. The S&P 500 lost 29.35%. August 1987, ADX black, well above both green and red. And eventually, really bad things happened in a relatively short period of time. From this point here, August 31st, 1987, to the bottom that was reached in early December 1987, the loss was 32.11%. This is our euphoric state, March 2000. Stocks always go up. ADX black is extended in a big way. And walking forward from this look, really bad things happen for a long period of time. From this point here, the S&P 500 lost 48.17%. You can see about halfway through calendar year 2014, ADX is well above green and red, still in an extended state at the end of May 2015. And walking forward from this point in the S&P 500, the market gave back 13.21% before reaching a bottom in early February calendar year 2016. If we take all of the cases and only look at ADX in each case, it's pretty easy to see that the cases on the top of your screen look quite a bit different relative to the cases on the bottom of your screen. Therefore, the logical million-dollar question, does 2020 look more like the bullish cases or more like the bearish cases? At first blush, let's use cases that we would tend to be more familiar with. This is what black ADX looked like in August 1987. ADX in March of the year 2000. ADX here before the secular trend really took off in September 1982. And after things started to turn in the wake of the financial crisis in November 2010. If we throw ADX below the chart of the S&P 500 that's dated January 31st, 2020, we can see that the present day looks like the sleepy cases and really doesn't look anything like August of 1987 or March of 2000. From a factual, and we can measure it, perspective, there's really no way to argue against the fact that the present day looks a lot more like July 2016, November 2010, September 2004, June 1992, and the end of September 1982. And the present day really doesn't look anything like December 1936, May 1946, August 1987, March of 2000, or May of 2015. Thus, from a probability perspective, since the present day looks a lot like these cases, it might be helpful to answer this question one more time. How did stocks perform walking forward from these similar looks in history? We already know the answer is extremely well. If we put it in summary format, the average gain in the S&P 500 after we could see this, measure it, and put it in a model was roughly 345%. Maybe more importantly, the average duration of the gain after we could see this, measure it, and put it in a model was 8.2 years. The median duration was 7.7 years. And remember, we said that we use ADX as a context tool rather than a timing tool. And when we look at the present-day look of ADX in this context, and in this context, and in this context, and then we ask, does all of this align with or contradict everything that we've been talking about since January of 2019, including the demographic analysis that was presented on October 18th, 2019? No opinions needed. The answer is all of it aligns with everything that we've been talking about since January of 2019. Everything that we just covered with ADX also aligns with everything that we just covered on February 7th, 2020. You can find that video by Googling the title on the left side of your screen. We would not expect the present day to look like the cases on the top of your screen, And we would expect the present day to look more similar to the cases on the bottom of your screen. And since historically this type of look, which is similar to the look in the present day, produced a situation walking forward where good things happen for a long period of time, it's very difficult to argue that anything that we've just covered contradicts any of this. And it's very difficult to make the argument that everything that we just covered, hard to say it contradicts any of this in any way. And it's extremely important to note, how do we use all this? The studies help us assess the probability of good things happening relative to the probability of bad things happening, which is significantly different from predicting or forecasting. Our goal is to keep these videos accessible to all. There are several ways that you can help us with that. They're shown on your screen. Is there any other factual data that we can review to help us test this thesis? Yes, this is a chart of the NASDAQ Composite Tape Index. It's a way to measure and track market breadth. Bottom of the screen is CCI, according to StockCharts.com. The Commodity Channel Index is a versatile indicator that can be used to identify a new trend or warn of extreme conditions. We're looking at all of the data that we have back to the late 1970s here. This is a relatively rare setup here. CCI came down near the center line here and then was able to come back and get a monthly close above 100. This look here and this round trip like this is similar to this first close back above 100 in 1985, similar situation in 1988, 1995, 1999. You can see 2012 here. We come down, come up. This look here, very similar to this look here. Thus, since this just happened, it might be helpful to answer this question. How did stocks perform after similar setups in 1985, 1988, 1995, 1999, and 2012? The answer is, in most cases, extremely well. 5 years later, 80% of the cases, the S&P 500 was higher. The median gain was 82%. The average gain was 78%. Since this is the NASDAQ Composite Tape Index, you might be wondering, how did the NASDAQ do? The answer is, in most cases, extremely well. Once again, 80% of the cases, the NASDAQ was higher. 5 years later, the median gain was 96% in round figures, and the average gain was right around 100%. Wait a minute, Chris, you seem to be glossing right over that case that has a lot of yellow and red. You might have noticed that case is dated December 31st, 1999. We do have to look at that case because this setup here is very, very similar to this look here. 1999 and here, similar to the present day. So how concerned should we be about this case? Well, it's relevant because the setup is similar. However, we know from past videos there are some significant differences between the present day and the late 1990s. In fact, at the beginning of this video, we just showed that the present day setup here, the sleepy ADX look, really doesn't look anything like the look, the extended, obviously extended look that we had in March 2000. This is the look in March 2000, black ADX, well above both green and red. This is the look at the end of January 2020. This really doesn't look anything like this. And this really is just another way of representing this, a topic that we've covered numerous times in the past. This is an extended and vulnerable market. This, not so much on a relative basis. Thus, from our perspective and under our approach, it might be helpful to know, what does this table look like if we remove the 1999 case? The answer is very, very, very good. 100% of the cases higher 6 months later, 9 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. 1 year out, average gain roughly 29%, median gain hovering right around 28%. Simply telling us to keep an open mind about much better than expected outcomes. As you might imagine, the NASDAQ looks even better. 100% of the cases higher 6 months later, all the way out to 5 years later. 2 years in, the average gain was 40% from the date of the signal. Hypothetically, would be very, very similar to walking forward from the end of January 2020, telling us it's within the realm of historical possibility that the end of January 2022, it wouldn't be shocking if the S&P 500 was higher by 23%, all the way up to 59%. And in the NASDAQ's case, 2 years out, it wouldn't be shocking if we were up over 40%, or if we were roughly flat. In the 1988 case, walking forward, good things happened and then bad things happened. But even in that case, the NASDAQ was higher by almost 25% 1 year from the date of the signal. But this number here and this give back here reminds us that even if good things happen for a long period of time, some really, really bad things like 1987 can happen between point A and point B. Hypothetically and historically, let's assume in September of 1982 or June of 1992, or in this case, and this case, we said there's absolutely positively no way that the stock market could go up for a long period of time. And let's assume we were shown a similar demographic analysis in this window here, and we basically were skeptical. Or if somebody told us in this window here that we were in the early stages of a secular trend, but we decided that it was safer just to sit on cash. Or if someone showed us this setup in 1985, 1988, 1995, 1999, or 2012, and we said, I don't believe it. How costly could that type of skepticism and/or closed-mindedness have been? Sometimes it's a little bit easier to understand that question looking at dollars rather than percentages. So let's just look at the average and median outcome walking forward and look at some hypothetical projections. If I invested $1 million and something similar happened walking forward after the present-day CCI setup, we earned the average return looking out 5 years and or the median return looking out 5 years, hypothetically that $1 million at the end of 5 years could have been worth over $2 million or somewhere in the neighborhood of $1.8 million. Simply reminding us that it's prudent to keep an open mind about a wide range of outcomes. And based on human nature, it's very, very easy to look at a table like this and expect the stock market to be up every day, every week, every month, and or every quarter. We all know that it doesn't work that way in the real world. These are the maximum drawdowns walking forward from the date of each signal. And you can see even in the bullish cases, a drawdown between 1 and 6% wouldn't be shocking. As human beings, when we see red screens, similar to what we had during the trading session on Friday, February 21st, from an immediate gratification perspective, it might be easy to hit the sell button to try to avoid the short-term pain. But the whole purpose of performing these studies is for us to better understand what day-to-day volatility might look like in the short run so we can have a higher probability of being satisfied in the longer term. So when we see red screens and we have realistic expectations about short-term context, it might be a little bit easier to avoid eating the piece of cheesecake and instead getting on a treadmill. Historically, you had to endure these type of drawdowns to lock in these type of returns. And understanding present-day data in the context of history can help us make better decisions from a probability perspective during red days, red weeks, red months, and even red quarters. For example, over the past several weeks, we have performed numerous maximum historical drawdown studies that have told us that it wouldn't be surprising, based on the hard evidence that we have in hand today and in the context of history, to see the market have a 1 to 6% give back after a rally like this. And while it may not feel that way during Friday's session, The S&P 500 printed a new all-time closing high just 2 short days ago on Wednesday, February 19th, 2020, at the level of 3386. Thus, we know from a lot of studies that we've covered in recent weeks that a giveback of 1% or 34 points from this peak wouldn't be shocking. 2%, 3%, 4%, 5%, or 6%. A 6% giveback relative to this all-time high on Wednesday, February 19th would be a drop of 203 points, and we would come down to this line here at 3183. This is what the exact same chart looks like on Friday, February 20th at 2:25 p.m. with the S&P 500 down 42 points. It's very, very difficult to say at this point that we're seeing anything that's particularly shocking or that seems to be varying from the historical script or our expectations in any meaningful way. Kathy was nice enough to update the trend strength model during the trading session on Friday. We're still sitting at a short-term score of 100 and a long-term score of 100, telling us that the facts that we have in hand today, things that we can see, measure, and put in a model, things that we can measure objectively, no opinions needed, all of that is telling us, regardless of how far we pull back, probabilities say eventually the market is going to go on and print a new all-time high. That statement is based on what we know on Friday, February 21st, 2020. And we are more than happy to adjust those statements and/or our assessment of the probabilities if and when the facts change in a material manner. That may happen very soon, but it hasn't happened yet. It may be very, very easy on Friday to say, but what about the coronavirus? The market is well aware of the coronavirus and has been well aware of the coronavirus now for several weeks. The coronavirus is baked into this number, it's baked into this number, and it's baked into the look of this chart, and it's baked into the look of every single chart and signal that we've covered in this week's video. The market is down 42 points intraday on Friday, February 21st for a very good reason. Just as the market had drawdowns and givebacks for very good reasons in 1985, 1988, 1995, and 2012. And in every single case, after 100% normal and to be expected volatility, really, really good things happened for a long period of time. And the 1999 case is still important, and these red figures are still important because they remind us that if the facts change, we must be 100% willing and able to adjust the probabilities and adjust our allocations if needed. And it might be tempting to look at a table like this and say it should be easy walking forward. These are the same cases. It's never easy. And we have a relatively new FAQ on our website. Here's the question here. Here's the answer. These figures here remind us that it's extremely important to remain open to all outcomes, from wildly bullish to wildly bearish. And the only way that we can do that and keep our ego in check is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management LLC or CCM is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.